Hi, this is Shelley Kraft, and welcome to SNN Live. We're coming to you live from the Cambridge House Resource Conference 2012, right here in sunny Vancouver, BC. I'm here with Ron Hera of Hera Research LLC, newsletter writer, ladies and gentlemen. I'm sure most of you have heard of it. He's a featured speaker at Cambridge. Welcome to SNN Live.
Shelley, thanks for having me on.
Perfect. So, what are you speaking about, Ron?
Well, I'm calling 2012 the end of cheap everything. It's not the end of the world, but it's the end of low-cost oil. I think we're going to see oil go north of 100 this year, and it'll never go back.
The end of cheap everything. Boy, oh boy, you've opened up a can of worms right there. So what's led you to make that assumption?
Well, I think the monetary problems that we have in the world today, especially the Eurozone problems and the ECB monetizing European debt, essentially, that's going to cause massive inflation. And we have an inflationary policy response from the Federal Reserve as well, specifically the European swap, the swap lines to the ECB and so forth. So these inflationary policy responses are going to cause global commodity prices to rise.
What about the effect of the Euro banks putting up $250 billion to bail out any of the European countries that could possibly force the dissolving of the euro?
Mm-hmm. Well, the EFSF and the European Stability Fund mechanism, those essentially are still inflationary. I mean, the whole idea of issuing euro bonds or having the IMF come in and do bailouts for Greece together with the ECB and so forth, those are all inflationary measures, and that's exactly why. I mean, the rules are basically that they don't want any banks to fail and they don't want any sovereigns to default, because that would trigger a lot of credit default swaps. So the problem there, of course, is that then you have institutional failures because of the liabilities from the credit default swaps. So if the rules are that you can't have banks fail and you can't have sovereigns default, then printing money is the only way out.
I was thinking those same two words, print money.
Yeah.
So you're coming up and you're stating the problem. What's the solution, Ron? More people want to know what the solution is. We're hearing a lot about the problems. What's your suggestion for a solution?
Well, at the end of the day, it's just not possible to have over-leveraged banks and excessive levels of debt in these government debt, the federal debt in the United States and the debt of the Eurozone countries. It's not possible to have those conditions without having a breakdown of the economy. The debt levels are crushing the economies of Europe, crushing economic growth in the United States. The debt levels are too high. The answer is to default. The problem with that, of course, is that causes bank failures. Well, the banks need to fail. You can't have a policy where banks can't fail and sovereigns can't default. That's going to cause currency devaluation. It's going to cause global chaos.
Well, but the end result is that when a government defaults, consumer confidence drops below the radar. And, you know, it's a scary thought for a lot of people. And that's instilling the fear to not let that happen, right?
Well, that's exactly right. But the problem is that as the currencies continue to devalue, in other words, the euro and the U.S. dollar, and obviously the Chinese will have to devalue the RMB to keep up. The Japanese will have to devalue the yen. We'll probably see further interventions to devalue the yen. So the problem with that is that global commodity prices will rise. And the consumers in the U.S. economy, for example, where there's virtually no economic growth, they can't afford higher oil prices, but that's what's coming.
But the Chinese government has 2 trillion RMB stuck in surplus.
Yeah, and they're buying resources all over the world. They're trying to get rid of those dollars and get rid of those treasuries, and that's the right thing for them to do. They need to put that supposed wealth into hard assets.
Then why have they bought so much of the U.S. paper?
Well, it's vendor financing. They buy treasuries to help fund the U.S.
And then they send their publicly traded companies to become public in the U.S. to take dollars back out of the U.S., right?
Well, yeah, it's a vendor financing arrangement, essentially. So the Chinese are lending to the U.S. The U.S. are buying Chinese goods. We've got a $500 billion trade deficit, approximately. We're the single biggest customer of China as a country, although the Eurozone collectively is actually bigger than the U.S. But still, the U.S. is the biggest customer of China. So that's why they're lending money to the U.S.
So how smart is Canada?
How smart is Canada? Well, I think Canada is in a pretty good position, although Canada also has a high level of sovereign debt. The debt per capita in Canada is also quite high.
But when I look at Canada and how the Canadian government is operated and how they're so devoted to their commodities, and how, you could walk around and see investors, even at this conference, and they're buying commodities, they're taking delivery of gold. I think that there's a little bit of an edge there over what U.S. investors may be doing at this time.
I completely agree. Setting aside the government debt situation in Canada, Canada is a resource-rich country, so there's a huge potential. We're in a bull market for resources and commodities. There's no end in sight for that. As global commodities rise in price because currencies are being devalued, we're going to see Canada booming. I mean, this bull market is going to continue.
I happen to agree with you, by the way, so you got a fan right here. So what's your website?
HeraResearch.com, Hera research.com.
And what is your speech going to be on at the conference?
Well, I gave a speech on the end of cheap everything. So I'm calling 2012 as the year that oil goes north of 100 and doesn't go back. And I mean Brent crude, sweet light crude. If you look at the production decline curves, you can see that we're already past peak production, but we're not running out of oil. We're past the peak production for cheap, easy oil. So it's the cheap oil theory, not the peak oil theories. It's the end of cheap everything.
What's your background?
Well, I was a software entrepreneur, and I switched to hard assets after the dot-com bubble crashed in 2000.
Well, you've come a long way, I'll say that much.
10 years.
Ladies and gentlemen, Ron Hera, Hera Research LLC, newsletter, go check it out. Website one more time.
HeraResearch.com.
Thanks for coming.